So you've identified that capital is grossly mispriced and the collateral in the traditional world is really overvalued, whereas Bitcoin is undervalued. And so you saw this opportunity. You've released these credit instruments. You've got Strife, Strike, Stride, and now Stretch. Let's break it down a little bit further. Can you just share, for a lot of people, they don't really understand what is a preferred stock. It says stock or share, but it really acts more like a credit, like a bond. You're getting a yield. So can you talk about what a preferred is? And these are specifically perpetual preferreds and how unique that is in the market.
Okay. A preferred stock is a second class of stock other than common. Common stock is you're just the final owner of the company, and you don't really have any particular preferences. You don't get any particular guarantees from the company. But if you create a preferred stock, that stock can be given a dividend yield. We can say that stock's going to pay this dividend monthly or quarterly, or it's going to pay a dividend that floats with SOFR. It could pay a fixed dividend. It could pay a variable monthly dividend. So you can give it certain cash flows and certain yielding rights. The stock can also have conversion rights. So you can say, hey, this converts to 1/10 of a share of my common stock, or 1/5 of a share, or it's fully convertible. So you can give it any amount of equity upside. You can give it any amount of yield. You can give it liquidation preferences. You can make it senior, and you can give it guarantees like it's a cumulative preferred dividend. So if we miss our dividend, we'll accumulate it. Or you can give it penalty. You can say, if we miss it, we'll pay you a penalty. You can pretty much write anything into the share that you like. So there are many different types of preferred stocks. It's a generalized container. And
it's not debt where you have to pay it back, right? It's not like a convertible where you have to pay the principal back. You raise the money and you don't pay it back.
Yeah, generally it's different than a debt instrument because a debt the principal has to be repaid at some point certain. You could make it more debt-like if you said, hey, the holder has a put right to put it back for cash. And you could make it look more like a debt instrument if you wanted, or if you basically give the holder the right to get all their cash and principal, or to redeem it. If you gave it a redemption right at some point, that would look a lot more like debt. Or you can make it look a lot more like equity if you said it's non-cumulative, like Stride is non-cumulative. So the principal never comes due and the dividend could be suspended without a penalty or without an accumulating liability over time. So you have extremes from very, very debt-like preferreds to very, very equity-like preferreds, everything in the middle. And that just makes it a very flexible security for a public company to issue. Now, if you happen to be a public company and if you have a lot of Bitcoin, then you could create this security and then you could take it public. So the first innovation is to create a preferred. The second innovation is to take it public and then you IPO it on like a 4-letter ticker, like STRC. And the third innovation would be, if you do take it public, you might put a shelf registration against it. And in that case, that means you might sell $1 billion of it up front, but then you might sell 50 million a week or some amount of it continuously, almost like an ETF gets bigger, like IBIT got bigger because every single day capital flows into it and they increase the number of shares of an ETF. So when you create a preferred that's got a shelf registration that's public, you've almost created a kind of proprietary ETF, right? You've created a new financial creature. It's got all the benefits of an ETF, but it's got also the benefits of a proprietary asset because you're creating the credit instrument in real time, as opposed to I collect someone's money and I'm running a junk bond ETF and I have to go and I have to buy a bunch of junk bonds. So an ETF provider has got a wrapper on someone else's assets. But when you create a digital credit instrument as a preferred, you're actually creating a native instrument back integrated all the way to the Bitcoin. And so
over collateralized.
Yeah. And then in that particular case, you could create You could create a preferred that is 10x over collateralized that pays 10% dividend and it pays that forever, right? That would be an instrument and just say, that's what I'm going to sell. And I can sell a certain amount of that. What we did was we created 4 different instruments so far. The first one we created was STRK. And the idea with STRK was, let's give people a dividend, 8% at par. Let's make it par value $100, pay an 8% dividend stream, and then give people a conversion right to 1/10 of a share of MSTR so that, you know, if the strategy stock is trading at $350, you have $35 worth of equity inside that instrument, right? So that was like, have some equity upside, have downside protection via the liquidation preference, and then have continuing income via the dividend. So that was a very simple, well, not a simple instrument, but an idea, which is I want the upside with very little downside, and I want yield while I'm waiting. The second instrument we created was STRF STRF. And that was a 10% dividend yield at par. So we're going to pay 10% interest in a way, or 10% yield on a $100 instrument forever. Okay, a 100-year bond that pays 10% yield, right? You just don't see that very often. And we made that senior in the capital structure. So we basically put as part of the security, one of the covenants in the security is we won't sell any other preferred stock senior to STRF. So STRF will always be first in preference, senior long duration credit. And that's very comforting to credit investors who are very risk averse, because they would say, well, I'm going to get paid before everybody else. So that makes my principal much better protected. And that gives me, in theory, that's credit positive. It gives it a better credit rating in their eyes. So we sold that, and that traded above par. So that traded way up. So it was yield. And the idea was, as the credit improves of our company, and as people get more comfortable with Bitcoin, as the price of Bitcoin goes up, that could go from 85 to 100 to 110 to 120 to 150. It could go to 200. So it could trade way up above par, because it's totally perpetual. And that sets the cost of capital for our company. Like that is the investment grade.
Yeah.
If you're saying what would be the long-term, the 30-year bond rate for an investment grade Bitcoin company, that's setting that rate by the market right now. So then the third thing we did was we created STRD. And the idea of STRD is, what if we just sold STRF, but let's just take away the penalty clause and the cumulative effect? We literally took out like 2 clauses. And it's the same thing. It's still 10% at par. But you would say, well, this is junior long-term credit, not senior. So the senior one looks more bond-like, and you've got not a bond, but it looks less risky.
Less risky, higher in the capital stack.
Yeah, higher in the capital stack. And this looks more risky,
more
lower.
like junk.
It's just right above the equity.
Right.
So we sold that, and that trades with an effective yield of 12.7%, whereas STRF trades with an effective yield of 9%. So a 370 basis point credit spread appeared between the least risky and the most risky. And people say, and ironically, the STRD deal was twice as successful as STRF. It was twice as big. And people would say, well, why would someone want to buy that when it doesn't have a cumulative right, it doesn't have penalties, and it's junior? And the answer is because they believe in Bitcoin and they trust the company.
Yep.
And they want the yield, right? Well, you would rather have 12.7% in your bank account than 9%. And so the issue is, do you trust your bank? If, you know, at some point, if you trust your bank and they offer you 12 instead of 9, you know, then you're going to do that. So now who else trusts the company? The equity holders, right? Just like who trusts Bitcoin? The Bitcoin holders.
Yeah.
At some point, you decide what you're going to trust. And this is an instrument that provided 2 benefits, well, many benefits. One benefit is it gives people that believe in the company and believe in Bitcoin the ability to get paid 12.7% dividends. That's great for them. The second is it gives the company the ability to build collateral that's junior to the senior instrument. So it's credit positive. It's good for strife. It's good for strike. It's good for, everything else. And then it also gives the company a very scalable way to generate leverage to buy Bitcoin, which doesn't have credit risk. So in theory, if there's a market to buy $100 billion of Stride, we could sell $100 billion of Stride and we could lever the company to 90% leverage and we would buy Bitcoin with it. And that would be good for Bitcoin. That would be good for the equity. If that was good for the equity, that would be good for the equity component of Strike. You see, so it's, and
Flywheel.
Of course, because we bought all this Bitcoin, that means that Strife would be 50x over collateralized. Yeah. So it's actually good for the credit, good for the converts, good for the equity, good for Bitcoin, and then good for the Stride holders, right? So it's kind of the flywheel.
Yep.
And that's why we did the third. And then the last thing we did was stretch. And the idea with stretch was people said, yeah, I'd like to get 10% bank account instead of 5%, but I don't want the volatility. I don't want to think that maybe the principal would trade up $10 or trade down $10 a share. Like if I buy it and it's trading at 110 and then the interest rates change and it trades to 105, I'll have lost 1 year worth of interest or 1 year worth of dividends. So we wanted to find some way to get to $100 and keep this price right around par, right around 100, lowest volatility imaginable, and extract the yield. Okay, and so the idea of stretch is, well, we don't want the duration risk. What Strife has is long duration. That means effectively 120 months of interest duration. That will cause the principal to move up and down, but below or above par a lot. In fact, 1% move in interest might cause a 20% change in principal if you have a long duration, a 20-year asset, right? So what we wanted to do was strip all the duration off. So not 120 months, we go to 1 month. And we wanted to, and when you strip the duration off, you strip the volatility off because the 30-year bond trades much more volatile than the 1 month treasury bill. So we wanted to strip the volatility off when we strip the duration off. And to do that, we had to create a monthly instrument, not quarterly. So we basically took the dividend to a monthly cash pay, and then we had to create a variable dividend rate. So this is the first time in modern capital markets that a company created a preferred stock that has a variable monthly dividend, right? And so we call that a treasury preferred. We invented the treasury preferred stock with AI. I used AI to do it. Yeah. Nobody else would have thought to do it because they never had an asset that would justify doing this. And in essence, stretch becomes like it's not quite a high yield bank account because you don't have perfect zero volatility, and you can if you had $1,082.32, you would get exactly $1,082.32 tomorrow if you asked for it. It's not that, but you would be pretty close, and you could put money in it that you needed to hold for a year. With very low volatility, you could collect the 10% dividend. And then if you needed the capital back, you could redeem it into the market and get your capital back. So the idea is a Bitcoin-backed money market type instrument. Not quite as good as a money market. They're less volatile, but we wanted to compete with that, with Bitcoin backing it.
So you're building out a whole yield curve backed by Bitcoin. Right. These are perpetual. Here's where I feel like people get confused. You promise not to sell your Bitcoin, right? So if you aren't selling the Bitcoin, where does that yield come from these instruments? That's the question I hear from the average person who's considering, like, what are these instruments actually? So how does that work exactly?
So we've got about $6 billion of these preferreds. We pay out about $600 million a year in dividends. The company enterprise value is about $120 billion. and we sell about $20 billion worth of equity a year.
Mm-hmm.
So you think about this, we basically sell the first 600 million of the equity, we use it to fund the dividends. The rest of the $20 billion, we just buy more Bitcoin with. So we're raising capital at a ferocious rate in the equity capital markets, and maybe 5% of the equity capital we've raised, we've earmarked for dividends. The rest, we just buy more Bitcoin. In the event that we couldn't sell equity for some reason, we actually have the Bitcoin itself, and we can sell either credit instruments against it, or we can sell derivatives. So for example, we could sell Bitcoin derivatives. We can sell futures against Bitcoin, or we could sell out of the money call options. And there's something called the basis trade, where you can actually sell the future against the spot, and you can capture a yield if you have Bitcoin as collateral to post against that trade. So the company's primary method of paying the dividends is we just sell equity. Our secondary methods would be to sell derivatives on the Bitcoin itself. And then the credit markets are open to us, so we could also tap various credit markets from time to time.
And is the goal to have these instruments rated by the big credit agencies? And what would that mean?
Yeah, the company's campaign right now is to become the first investment grade Bitcoin treasury company and crypto company in general, and to get all of the instruments rated by credit rating agencies. And that's an elaborate process of lots and lots of meetings and lots of education.
Oh, really?
But over time, I'm confident we'll get there.